Hello guys, welcome to this course. In this course, we'll be studying SMC concepts, we'll be learning market structure. Basically, we'll be learning how algorithm moves the market, right? So this is what we'll be learning in this course from completely beginner to advanced level. And I hope that you have fun and you enjoy while you go through the course, and also make sure you practice everything immediately after you study a topic. That's very important. Okay, so now let's start this course. So today we'll be studying about bias. Bias means direction. So if you want to trade anything, doesn't matter if it's gold, if it's crypto, if it's indices, the most important question is, what is your direction? Are you going to buy? Are you going to sell? What are you going to do? So if you're able to find your bias correctly, then you have already done 50% of the job. Now you just have to execute the trade. So today we'll be learning how to find that direction, how to find that bias of the market. And whatever we will learn in this course, you can apply it in any kind of market, because the fundamental of any market remains the same. Okay, doesn't matter if it's crypto, if it's even stock market, if it's indices, the same thing can be applied in all kinds of market. Okay, so now let's understand how to find the bias of a market. So to understand bias, you have to understand two things. One is point of interest, the second one is liquidity. Now you have to keep this in mind, that market always moves from a point of interest to a liquidity. Always. Doesn't matter what kind of market it is, it always moves from point of interest to a liquidity. Now what are point of interests? Basically there are two types of point of interest. One is called blocks, where we have got the most popular one, which is the order block. Then we have got mitigation block, breaker block. Then we have got gaps. Inside gaps, we have got the most popular one, which is a fair value gap. Then we have got imbalances like volume imbalance and gap imbalance. Now, I don't want to go through all of them right now. I'll just show you what is an order block and what is a fair value gap. So it's very simple. Let's say we have got three candles. Let's say we have got three green candles like this, back-to-back green candles like this. Okay, so if we have got this kind of three back-to-back green candles, and first candle, so let's say this is the first candle, let's name it first candle, candle number 1. Okay, this is candle number 1. Then we have got candle number 2 over here, and we have got candle number 3. So when we see this kind of three candle pattern, where the first candle and the third candle are not in contact with each other, then you can say the difference between these two candles, or the gap between these two candles, this is what is called a fair value gap. Okay, what is it called? It's called a fair value gap. Okay, represented by FVG. So the concept is that whenever market creates fair value gaps, market will come down to fill this gap, and then it will continue its trend. Okay, now this is for bullish market. The same thing can be applied for a bearish market as well, where we will have three red candles like this. Okay, back to back three red candles like this. It doesn't have to be back to back three red candles. It can also be a green candle. The candle color doesn't matter once again. Then we'll have this as the fair value gap. Okay, this will be our fair value gap. In this case, this is going to be our candle number 1. This is going to be our candle number 2, and this is going to be our candle number 3. So when we see that the candle 1 and 3, they're not touching each other, they're not in contact, then the gap between these two will be called our fair value gap. And in this case, you can expect that market will retrace to the fair value gap before dropping further. Okay, this is the concept of fair value gap. Now you have understood what a fair value gap is. Now let's understand what is an order block. Now, fair value gap and the order block, these are the most popular gaps and blocks that you see in all kinds of market. No matter what market it is, these will be the two most popular types of point of interests that you will see in all kinds of market. Okay, so the candle just below the fair value gap, this becomes an order block. Okay, this becomes what? An order block, because before that the market structure would be, let's say market was dropping like this. Let's say we have got multiple red candles like this. Okay, and we see another red candle like this, and after that market starts this upside move. So this was the last green candle before market started to push higher, before market created this fair value gap. So these candle becomes our order block. Okay, this is what is called what? This is called an order block. Order blocks will always be just below a fair value gap when the structure is bullish, and in this case this is going to be our order block candle. Okay, this will be our order block candle, and when the market is bearish, the order block will be just above a fair value gap. Okay, so market can either tap into the fair value gap and push higher, or it can also drop to the order block and then it can push higher. Okay, and in case of a bearish market, either it can tap into the fair value gap and push lower, or it can go to the order block and from there push to the downside. Okay, so I hope you have understood what a fair value gap is and what a order block is, and these are the most important and the most popular types of point of interests that you see in the market. Okay, so now I'm going to remove this. Okay, so apart from that, inside blocks we have got mitigation block, breaker block. So I will bring a separate video on blocks. I'll also bring a separate video on gaps, where we will also study imbalances such as volume imbalance and gap imbalance. But for now, we have learned what an order block is and we have learned what a fair value gap is. Now let's talk about liquidity. What is liquidity? So here we have got low and high resistance liquidity. We'll talk about it in a later video. And now let's talk about what are the most common types of liquidity. So what is liquidity? Basically, let's say we have got a green candle like this, and we have got a wick like this. Okay, so we have got a candle, and we have got the high of the candle, and we have got the low of the candle. Now these highs and lows, these are called liquidity. Okay, both the high and the low of any candle, doesn't matter the time frame, whether it's a daily candle, it's a weekly candle, whatever it is, it doesn't matter. Okay, daily, weekly, doesn't matter, monthly or 4 hour or 5 minutes, doesn't matter at all. Whatever time frame it is, every candle's high and low, they act as points of liquidity. Okay, and these are very important points. Another way of finding liquidity is whenever you see swing highs or swing lows. Now, what are swing highs? Let's say we have 3 candles like this, a green candle, another green candle. Once again, the candle color doesn't matter. And you see another candle like this. Let's say this is a red candle, and we've got a wick on the upside like this, and let's say we also see wicks on these 2 candles as well. So whenever you see these kind of 3 candle pattern where the high of the middle candle is above the highs of both the candles on the 2 sides, this is called a swing high. What is it? It's a swing high. And the opposite of this is going to be swing low. Let's say market is dropping like this. We see a red candle with a wick. Then we see another drop like this. And let's say this is also a red candle. Once again, the color doesn't matter. It can also be a green candle. Let's consider it as a green candle. Okay. And we see another candle. Once again, the color does not matter. The concept is what matters. Okay, so here once again we have got 3 candle swing, where the low of the middle candle is below the low of the candles on both the sides. When you say this, then this is going to be considered as what? This is called a swing low. Okay, and once again, the swing high is going to be acting as what? Liquidity. This swing low is going to be acting as what? Liquidity. Okay, so these are the two types of common liquidities that we see in any market, because in any market you will see candles, and every candle's highs and lows, they are going to act as liquidity, and every swing high and your swing low you see in any time frame. Once again, whatever we are talking about, you can use this in any time frame. It doesn't matter because market is fractal. So swing highs and swing lows of daily, of weekly, of monthly, doesn't matter. All of these are going to act as what? Liquidity. Now, popularly, or you can say most commonly, the type of liquidity that we use are going to be these swing highs and lows. This is what we generally look for, and even though the candles highs and lows also act as liquidity, this is not really used as much. Obviously, different traders have different system of trading. Some people also use this previous day high low, previous week high low. These things also matter, but what we'll be studying in this course, mostly we will be focusing on the swing highs and the swing lows. Okay, so I hope that it's clear to you that inside market there will be two things: point of interest and liquidity. And I hope you understood what point of interests are. Mainly there are two types: blocks and gaps, and inside them the most popular ones are order blocks and fair value gap. Inside of liquidity, we have got every candle's highs and lows acting as a point of liquidity, and most importantly, the swing highs and swing lows, doesn't matter which time frame, they act as liquidity. And like I have told you at the starting of this class, that to find the bias, you have to find out these two things. Okay, and market always moves from point of interest to liquidity, right? So if you find your point of interest and your liquidity, and you know that market will go to point of interest and then it will go towards my liquidity, that means you have found your direction of the market. Now you know whether to buy or to sell. It's that simple. Now I will show you examples and it will become even much easier. Okay, so now let me remove all of them. Hope till now you have understood everything that we have studied. It's very simple, very simple stuff. Okay, so now let's look at the chart in gold. So this is the weekly chart in gold. So let's look at the example. Okay, so this is the weekly chart, and remember, whenever we do our analysis, we always start from the higher time frame, preferably the monthly. Okay, we will always start our analysis from monthly, then we move on to weekly, we move on to weekly time frame, then we move on to daily time frame, and after that we move on to 4 hour. Okay, and then we go to the 1 hour time frame, and 1 hour is the last time frame that we watch. Below 1 hour we do not find our POIs or liquidities. Okay, because below 1 hour, this is just for scalpers or high frequency traders. This is not for us. We want to trade the algorithm, and for that we have to keep a respectable time frame, which is going to be 1 hour. We do not want to go below 1 hour to find point of interests or liquidity to find the bias of the market. Okay, so these will be our time frames that we will be watching, and you will see when you do the multi-time frame analysis how simple, how easy it becomes to understand the market intent, where it is and where it wants to go next. So this becomes so easy that you have already found your bias of the market, so 50% of your work is already done. Now you just have to execute the trade. Okay, Okay, so this is the most important thing, the time frames. Keep this in mind. Do not go to 15 minutes to find the buyers, or 5 minutes to find the buyers, or even 30 minutes to find the buyers, because we do not want to get trapped in the noise of the market. Okay, you can start from the monthly, go to the 1 hour, but do not go below 1 hour. Okay, keep that in mind. Okay, so now I'm going to remove all of them. Now let's say find out the bias of the market when market is over here. Okay, so let's go to the monthly and see what happened over here. Okay, so as you can see that here we had the weekly on 21st April, and okay, so let's go to the monthly. Okay, so in the monthly, let's say we are over here. Okay, we are over here, and market just printed this candle, and we don't know what's going to happen next. So how do we find the bias of the market? How do we find where gold wants to go next? Now watch this very carefully. So what we will do is we will mark all the POIs and the liquidities from the monthly to the 1 hour time frame. Okay, from the monthly to the 1 hour time frame. Okay, so in the monthly, this candle, I told you, this candle's high will be important. This will be acting as a liquidity. So I'll mark the high. This is a monthly level. So let's mark it as ML. Okay, monthly level. Then we have got the monthly candle's low, which is this one. What is this? This is once again a monthly level. So let's mark this. Okay. What else have we got? So the price, remember, it is over here, right? It is over here, and this is where we have to find out the bias for the market in gold. So in the monthly, we can see that we have got just these two levels, and market is over here, right? And now if we see over here, do we have any more liquidity? Do we have a swing high or anything like that? No. Do we have a swing low or anything like that over here? Then the answer is no. So now the question is, if market is over here, then where market can go? Because market has to go towards a liquidity. Now if it wants to go towards a liquidity, then which is the nearest liquidity point? Is it over here, which is 333 pips away, or is it over here, which is 213 pips away? It is over here, right? This is the nearest liquidity from where market is right now. That means the high chance for market to go will be to this high rather come all the way down to this low, right? So that means the chance of gold pushing higher this month will be much more than gold going down, right? So once we get the idea that monthly is indicating that gold is bullish and gold can push higher, in that case we can look for buying opportunity. Now I also told you that we also have to mark the POIs along with liquidity. So in the monthly, is there any POI do you see which is nearby to this current price? Then the answer is no, because over here once again we have got the liquidity, and below this we do not see any POIs. You see that this level was exactly tapped, and from here market went up. So there is no fair value gap, no order block, nothing like that. The only fair value gap that we have is over here, right? And below this we have got this order block, which is far away from where market is, and market has no interest to come all the way down for no reason. Remember, market will always chase the liquidity which is at the nearest point. Okay, keep that in mind. So that means in monthly we just have got the two liquidity levels, and this one which is at 3,500 levels is the nearest liquidity. So monthly is indicating that gold is bullish and gold should go for this liquidity rather than come all the way down to this low, right? So we can remove this low and keep this one, because now this is going to be our level of interest, or you can say this will be the level that will be looking to target, because now we have got a direction that market will go up, or it has a probability of going up, and this is where we will look for trades, right? We'll be looking for buying trades. Now let's go to the weekly and see what's going on. So in the weekly, we've got the monthly level, right? So let's just skip this monthly level in all the time frames. Now let's go to the weekly. In the weekly, we will do the exact same thing that we did in the monthly. We'll mark out the liquidities and also the POIs, right? And once again, this is the monthly candle where we're doing the analysis. So we'll keep this marked, okay? So remember, in the weekly, we have got this candle. We do not have this candle. Once the analysis is done, you'll see how simple this is and how powerful this is, okay? And make sure once you learn to find the bias, you practice this in all kinds of market, or at least in 2-3 markets that you trade, like gold or maybe crypto or whatever you trade. You apply this and watch for yourself whether it is actually working or not. Okay, so now in weekly, we can see that we have got this high, right? So this is a monthly liquidity, sure, but this is also a weekly liquidity as well, right? So we can also mark it as WL, a weekly liquidity. And over here in the lows, we can see that this is going to be our weekly liquidity, right? But once again, market pricing is over here. So there is a very less chance that market will come all the way down to this liquidity. Rather, it has a high chance of pushing higher because this liquidity is much closer to where price is right now, right? In that case, we will be looking for buying opportunities just like we did in monthly. So in the weekly also, we are bullish in gold, so we can remove this level. So talking about the POIs, we have got this as our POI, and yes, we can also consider this low, but like I told you, we will be mostly focused on the swing highs and the swing lows, and we will be considering them as liquidities. Remember? So keep that in mind. Now this is a 3 candle swing pattern, right? Why? Because this candle's low is above the lows of both the candles on the 2 sides, right? So that's why this candle's low is a swing low. That means what? This is a liquidity point, right? Okay. So now we have marked the liquidity, which is going to be the most important level because this is the nearest point where market can go. Now we have to mark the point of interests. So what are the point of interests that we see over here? Do we see anything over here? So yes, we see a fair value gap over here in the weekly, okay? Apart from that, do we see anything? So yes, we see another fair value gap over here, and below that we see order block, right? So we see 3 point of interests. Now remember, when you see multiple fair value gaps like this, let's say 1 candle, 2 candle, 3 candle, and let's say we have got another candle, 4 candles. So when you see multiple fair value gaps, in this case, this is a fair value gap, right? In this case, this is a fair value gap, right? Let's say we see more candles like this, back-to-back candles. Okay, so in this case, this is also a fair value gap, right? So when you see this kind of multiple fair value gaps, then which one should you consider? So you have to consider the first one. This will be the most important because this is the first imbalance where market is right now. So market is over here. So if it drops, then this first fair value gap will be the most important one. Okay, this is the first fair value gap, FVG. This is the second fair value gap, and this is the third one. So whenever you see multiple fair value gaps, the first fair value gap will be the important one, and the last fair value gap will be the important one. That means when you see multiple fair value gaps, either price will react from the first one and continue the momentum, or if it wants to give a deep pullback, in that case we will focus on the last fair value gap, which will be the third one, and from here price will continue. Okay, so in this case, this is going to be our order block candle. Okay, so keep this in mind. When you see multiple fair value gaps, the first and the last one, they will be the ones to focus. Okay, so here also you can see we have got multiple fair value gaps, right? You see we have got this as the first one. Okay, so this is also important. This as the last one. We see this as the fair value gap, and this as the order block. So you can consider the fair value gap and the order block as one single POI, one single point of interest. That's also fine. Or if you want to consider them separately, that is also fine. Now what you have to do is, you have found the liquidity where market wants to go, that is going to be this high. Now you have to wait for market to come down once this wick starts, tap into this fair value gap, and from here give you a displacement. If you see a displacement from here, then you will look for an entry and you will target this high. This is what you want to see. But if it does not happen, if this level is not able to displace gold, in that case you will focus on these last POI, and from here you will be looking for a displacement, and once you see that, you will take an entry and you will be targeting what? You will be targeting the weekly liquidity. And once again, this is very important, remember that whenever you enter from a weekly POI, this is what? This is a weekly POI, right? So your target is going to be a weekly liquidity. Now, if you enter from a daily POI, your target will be a daily liquidity, right? If you enter from a 4-hour POI, your target will be a 4-hour liquidity. Okay, so keep this in mind. This is called storyline. So that means your target will be always at the same time frame where your POI is. This is very, very important. This will give you the strength to hold the trade all the way to your target. Okay, so keep this in mind. So here we are entering from a weekly POI. So our target will be what? It will be a weekly liquidity, which is also monthly liquidity, but this is also the weekly liquidity. Why? Because this is the weekly swing high, right? So keep this in mind. The POI and the liquidity should be in the same time frame. Okay, the liquidity will be your target. Liquidity will give you your target. Whenever you find the liquidity, this will be your target. Okay. Okay, so now talking about displacement, because I told you that market will come down, tap into your POI, and from here, what do you want to see? You want to see displacement. Now, what do I mean by displacement? So displacement basically means, now you have to understand the entry models. So let's say you get a weekly POI. You get what? You get a weekly POI. I don't want to go too much today, but just to give you an understanding so that you get excited for the next classes. Whenever you see a weekly POI, you will use your entries or will use your confirmations, let's say, in the 4-hour time frame. Or you can go to one time frame lower, and this is where you will look for displacement. Or you can say you can look for your entry. Okay. Now this is called time frame alignment. Time frame alignment. Okay, now let's say this is a daily POI. If it's a daily POI, then you will be watching for displacement, or let's say your entry in the 1-hour time frame, or you can go to one time frame lower at max, which will be the 15-minute time frame and not 30 minutes. Okay, so this is what time frame alignment is. Let's say if it is a 4-hour POI, if it's a 4-hour POI, you will go to 15 minutes, or you can go to 5. And let's say it's a 1-hour POI. In that case, you will go to 5 minutes, or you can go to 1 minute as well. Okay. Now keep this in mind. This is very, very important that you do not want to go below 1 hour to find your POI or liquidity. You do not want to go below 1 hour. Okay, now this will be your time frame alignment. Now since this is a weekly POI, our time frame alignment will be 4-hour or 1 hour. So now let's go to the 4-hour. Let's remove all these things. So now we have got what? We have got our liquidity and we have got our POIs, right? So you can see that market came all the way down, right? And market tapped where? Tapped into this order block. So let me remove this one and let me focus on this weekly order block, which is my POI. So this is what? This is my weekly POI. Okay, I hope everything is clear till now. If you have any questions, you can ask me later and we will go through the doubt classes and solve your queries. Okay, so this is our weekly POI. Now what we want to do, we want to go to 4 hour and look for a displacement to take our entry and target this liquidity which is of the same time frame, right? This is a weekly liquidity, so this is where we are going to target. Let's see if we have the entry or not. So let's shift our, yes, reference over here because this is where the market came down, tapped into the weekly POI. Now let's go to the 4 hour and see if we get any entry or not. So in the 4 hour, what we want to see, now let's talk about the entry model. In the 4 hour, what we want to see is market structure shift. That means what? That means, let's say we have got the weekly POI. What is this? This is the weekly POI. Doesn't matter what POI it is, any POI it is, you will use the same entry model for all the POIs. Okay, for all time frames, for all the POIs, you will use the same entry model. So this entry model is called market structure shift. Once again, if it's going too far, then make sure you watch the video once again, take time and go through it slowly and practice this, then it will become much more clear to you. Market structure shift. Now I told you in the weekly, if it's a weekly POI, then we want to go to the 4 hour time frame. Okay, so we'll go to the 4 hour or we can also go to the 1 hour, but let's focus on the 4 hour. So we will go to the 4 hour time frame, and in the 4 hour we want to see something like this. Let's say market is dropping like this, market taps our weekly POI and market pushes higher, market breaks the last high. This is what we call market structure shift. That means the structure of the market has shifted from bearish to bullish, and this is what we want to see. And remember, whenever this happens, it must give us fair value gap. If there is no fair value gap which is being created on this leg to the upside along with the market structure shift, then we are not interested to take any entry. But once we have got that fair value gap, then we can enter from the fair value gap. We can use a buy limit order. Stop loss will go below this low. And what will be our target? This entry is from a weekly POI, so our target will be a weekly liquidity level. Let's say the weekly liquidity is over here. Let me mark it as WL. So our target will be at this level. Okay, so this will be your trade setup. Okay, so same thing we will watch over here. Let's see, after market tap to this weekly POI, did we have a 4-hour structure shift or not? So as I can see, this was the last high and the structure shift was too far away, right? There was a structure shift, and also market gave fair value gaps over here during the structure shift, which is a good sign, but it is too far away. So let's see, do we get the structure shift in the 1-hour time frame or not? Because like I told you, if it's a weekly POI, we can refer 4-hour as well as the 1-hour time frame also. So here we can see that in the 1-hour, market was dropping, market was bearish, market created this low, this high, then this low, this high, this low, and then market breaks structure, right? So in the 1-hour, market gave us our market structure shift over here itself, but in the 4-hour, the market structure shift was somewhere around here, right? So in the 1-hour, the market structure shift was much earlier than the 4-hour. And let's see, was there any fair value gap when the displacement happened? So yes, we can see when market broke this to the upside, market has created some POIs over here. Market gave us fair value gap, market gave us order block. So we will be entering from the last POI that market creates, which is going to be this zone, right? So this is the last fair value gap plus order block, which I told you can be considered as one single POI. and this is where we will keep our buy limit. Our stop loss will go below the low that market has created. And what will be our target? Now I told you our target is going to be the liquidity level of the same time frame, which is our POI time frame. So our POI is weekly, so our liquidity will also be a weekly level. That means this is where our target is going to be. And you can see what market did. Market went all the way up, and you could have got 1:8 risk reward trade setup in gold. And you can see that after spending lots of time, market finally gave the full target. So this is how you take your entry, and this same concept can be used in any kind of market to find out the bias of the market. Now, how did we find the bias? We started from the monthly, we found the nearest liquidity, then we saw that in monthly there was no POI, then we came to the weekly. In weekly, once again we marked the liquidity which was the same as monthly. We marked the weekly POIs over here. We had some POI over here, but if you look, then there was no confirmation. If you go to the 4-hour or even in the 1-hour, you won't see any market structure shift that happened over here. But once market tapped the weekly order block, which was the weekly POI, market gave 1-hour structure shift along with displacement. Now we enter from the last POI that market has created, which is going to be this fair value gap plus order block. This is where we put our buy limit and we put our stop loss below the low that market has created, and our target is going to be the weekly liquidity level. Okay, so I hope it is clear how to find your bias of the market, how to execute your trade. Now let's see some more examples over here. Let's go to the monthly once again. So in the monthly, we can see, okay, so there was not much pullback. Let's go to the weekly and see what happened after that. So in the weekly, you can see what happened after market pushed higher, market took out the high, and then market continued higher, right? So let's remove this and watch the chart once again. So let's refer over here. So once again, let's focus over here. Let's say market created this high. So in the weekly, what will be our bias? Our bias is going to be bullish. What is going to be our liquidity? Liquidity will be this high. Like I told you, the candles highs and low, they act as liquidity. And what is the nearest POI that you see over here in the weekly? You can see we have got multiple candles, multiple fair value gaps, but I told you the first fair value gap and the last fair value gap, they are the most important ones. So here you can see market came down, market tapped to the POI, and after that market gave displacement and market went up. So this is your weekly liquidity. This is your weekly POI, and market pushes from weekly POI to your weekly liquidity. So once again, you should have gone to the 4-hour, taken your entry from here, or in the 1-hour, stop loss below the low and target the weekly liquidity, right? So I hope it is clear how to find the bias of the market. Here also we can see this is the recent price action. Market created this high and market dropped, and you can see this was our weekly POI, and from here if you get displacement in the 4-hour or in the 1-hour, you can take your entry, stop loss below the low, target the weekly liquidity, right? What is this? This is the weekly liquidity, right? The weekly candles high, and this is the weekly POI, right? So weekly POI to weekly liquidity, right? So this gives your bias, and I've already give you the time frame alignment. Use this to take your entries, and what will be your entry model? It is going to be market structure shift. Okay, so this is how you find the bias of the market. Now this can be used in any kind of market. If I show you silver, then this also moves in exactly the same way. This is the weekly chart, and here also you can see what market has done. If you look over here, then market dropped, market tapped into this weekly POI, and from here market pushed higher. What would be your target? The target would be weekly liquidity, right? And once again, here also you can see what market has done. Market came all the way down, market tapped into the weekly POI, but you can see that not a single candle has closed below this. Sometimes it will happen that market will come little bit lower in the fair value gap, that will mark, but once again market will retrace back. So if market is not able to close back in a strong manner and it creates wicks on the downside, then you have to focus on the lower time frame, because market can actually reverse from here. And once again market took out the weekly liquidity, right? So the same thing can be applied in all kinds of market. If I show you in Bitcoin, then once again the same thing can be applied over here as well. If we see then recent price action, you can see what happened. This is once again the weekly time frame. We have this weekly POI, market came down to the weekly POI, and then what happened? Market went up, took the weekly liquidity, right? So this is the fundamental of the algorithm which drives the market. So if you understand this carefully, then you can understand and trade any kind of market. Here also similar thing happened in weekly. There was no POI over here. The nearest POI was this fair value gap. So market came down all the way, just tapped into this, and once again went up and took out the weekly liquidity. Now this I'm showing you in weekly. You can do this in the daily time frame as well. The market concept remains the same. If I want to show you in daily, then I can also show you. I have given you this weekly example, right? We entered from the weekly zone, and from here we targeted the weekly level. Now if I show you in the daily, so let me remove them. So in the daily also you will see the same thing has happened. Once market came down, tapped into the weekly zone, from here market went up. You can see what happened after that. Market created this daily order block, market came down. So once market comes down and taps into the daily POI, what will you do? You will go to the 1 hour time frame or the 15-minute and look for your entry model, which will be the market structure shift. From here you will take your entry. What will be your target? It will be the daily liquidity. Now when you have got multiple swing highs, so you can see we have got one swing high over here, we have got another swing high over here, we have got another swing high over here. So we have got 3 swing highs. So all of them can be your targets one by one. The nearest swing high will be your first target, then you will target the next swing high, and then you will target the next swing high. So in the daily you will have 3 liquidities to target, and you can see market targeted one by one. Market took out this high, then market gave a pullback, created a new order block. From here market once again pushed higher, then your target is going to be this high, and after that you can target this high as well, which was also taken, and after that you will be targeting this high as well. So one by one market will take out all the highs. Here also you can see market came all the way down, but from here market did not give a displacement. It tried to, but market failed and market dropped. And then what happened? Market came all the way down, and once again market started to rise, and here again market created this POIs which market trapped, and market pushed higher, right? Once again the daily liquidities would have been taken. Here also market took out the high. Here also you'd have a new POI in the daily. Market took out this high as well. So one by one you can target all of these highs. As long as market does not take out the extreme high, which is the weekly liquidity, you can go to the daily and look for more buying opportunities. Okay, so this is how to find the bias of a market. Now this can be applied, like I have shown, in any kind of market, whether it's stocks, whether it is crypto, gold, doesn't matter. You can also use this for indices as well. The same concept can be applied in all of them. Okay, so I hope it is clear how to find the bias of the market. Now make sure you go to the chart and you mark the liquidity and the POIs, start from the monthly and then gradually go on to the lower. And remember, market will always take those liquidities first where market is, which one is closer to the price. So if market is trading over here and market closes above this high, then there is a chance that market will go for the next high, right? And if market closes above that high, then market will go for the next one. But if market just closes, it just takes out the high and then drops back, in that case we might see a pullback before it once again pushes higher. Okay, now that will come later. Once you see examples, once you test, you'll understand this thing slowly. Little by little, we'll go to all these things. But for now, I hope you understood how market moves. Remember that market always moves from a point of interest to a liquidity. Now, this is for any kind of market, doesn't matter whatever you trade. This is the basic market structure, how market moves from a point of interest to a liquidity. So in all of the examples that I've shown you, market moved from the weekly point of interest to the weekly liquidity. Also in the daily, all the examples that were shown, market moved from daily point of interest to daily liquidity, daily point of interest to daily liquidity, daily point of interest to daily liquidity, daily point of interest to daily liquidity. So your liquidity will be in the same time frame where you are looking for the point of interest. Okay, so both of them will be same, and this will give you confidence to hold your trade to your target. So this is for the first class, and I hope you had fun watching this session. In the next class, we'll be going through all of these topics one by one. We'll be studying about blocks, we'll be studying about gaps, and I'll be also bringing a separate video on liquidity where we'll go through all types of liquidity. There are more types of liquidities that we haven't discussed over here. Here we have got low, high resistance liquidity. We did not discuss this one, so we'll talk about it later. We've also got trend line liquidities and all that we'll talk about in a separate class. Okay, so that's it for today. I will see you in the next one. Till then, keep practicing, keep learning, and have fun. So this was a swing low, right? Why? Because this candle is above the previous, this candle's low, and this candle's high low is also above the low of this candle, right?